Let's talk about something wild. What if the government could reach back in time and change the rules of a deal you made nearly 20 years ago? Well, that's not some hypothetical question in Australia right now. There's a proposed tax change that's threatening to do exactly that, and it's sending a shockwave through the investment community.
I mean, just imagine it. You followed the law, you signed the papers, you finalized a transaction way back in 2006, you moved on. Then, almost 2 decades later, you get a notice in the mail, the law has changed, it applies to that old deal, and surprise, you owe more money. This is the incredible situation at the heart of a huge debate happening right now. So you're probably wondering, how is this even possible? We're diving right into the core concept here, which is something called retrospective legislation. Now, that's just a fancy term for when a government creates a new law today that applies to stuff that already happened in the past.
And this timeline, wow, it really puts the scale of this into perspective. We're talking about transactions foreign investors made in good faith way back in 2006, based on the laws as they stood then. Now, in 2026, new draft legislation wants to go all the way back and change the tax rules for those exact deals. That's a nearly 20-year reach back in time.
Okay, so what specific policy is causing all this commotion? Let's peel back the layers and look at what the tax change is actually all about.
At its heart, this is all about the Foreign Resident Capital Gains Tax, or CGT for short. It's pretty standard, really. When a foreign resident sells an Australian asset, say a piece of property, and they make a profit, the government taxes that profit. Nothing unusual there.
But here's where it gets really sticky. The government's line seems to be that this is just an integrity measure, clarifying the rules, closing a loophole they think some investors were using. But critics, including the major accounting body CPA Australia, are saying, no way. They see it completely differently. They're calling it a material policy shift, arguing this isn't some minor tweak, it's a fundamental rewriting of the law.
And that brings us straight to the core of the problem. CPA Australia, led by their tax expert Jenny Wong, has become a really loud voice against this proposal. They're raising some serious alarms about just how unfair and damaging this could be.
This quote from Jenny Wong, it just hits the nail on the head. A stable tax system, one that works, relies on certainty. It's this basic idea that you can make financial decisions based on the rules today without being terrified that the government will just change the goalposts 10 or even 20 years from now. When you start messing with that trust, well, that's a really big deal.
And the real-world impact for people, it could be huge. It's not just about getting an unexpected tax bill for a deal you thought was done and dusted. It could also mean getting hit with extra penalties, interest charges, a mountain of new compliance costs, and maybe even getting dragged into new legal battles. It's a real mess.
And to give you some context, Jenny Wong made a pretty chilling comparison. She said this whole thing feels a lot like a past tax fiasco called the Family Trust Election, which created years and years of confusion and disputes for tons of people. Her verdict? This new proposal? It could be even worse.
So the impact here isn't just about individual taxpayers. The concerns stretch way wider, potentially damaging Australia's entire economic reputation on the global stage.
This is what experts call the chilling effect. Look, the government might see this as just making sure everyone plays by the same updated rules, but critics argue it sends a completely different signal to global investors. The message they hear is the rules in Australia aren't set in stone. And suddenly, that introduces a whole new level of risk that could make investors think twice about putting their money here.
The logic is actually pretty simple when you break it down. A tax system with clear, predictable rules gives people confidence. It encourages long-term investment because the risk is lower. But a system where the rules can change after the game is over, that does the exact opposite. It discourages investment by jacking up the risk. At the end of the day, it all comes down to trust.
And to top it all off, it's not just what is being proposed that has people worried. It's how it's being done. The whole process has come under some serious fire for being incredibly rushed.
2. That's the number. The government gave just 2 weeks for experts, businesses, and everyone else to review and give feedback on these unbelievably complex and far-reaching changes. Just 2 weeks.
As you can imagine, CPA Australia just slammed this time frame, calling it completely insufficient. They argue that 2 weeks isn't meaningful consultation by any stretch of the imagination. It's nowhere near enough time to figure out the massive implications for old deals and complex business structures. They basically called it a major shock for foreign investors and their advisors.
So this brings us to a really fundamental question about how governments should work. On one hand, governments need to be able to close loopholes and make the tax system fair.
But on the other hand, investors and citizens need to be certain that the rules of the game won't just change after it's already over. This proposal really puts those two needs in direct conflict, and it leaves us with a tough question to